Welcome to Stock Talk with Nico Criticos. Today we're going to be taking a look at CVS stock and Walgreens stock, and we're going to do some comparison to see which one is the better investment. So first thing we are going to start with is this chart I made here, and it goes through all the different important things that I think should be compared between both companies. So the first one on the list is revenue growth. And this is these are 10-year averages, which means over the last 10 years, Walgreens has grown revenue at an average of 6%, and CVS has grown at an average of 10%. Walgreens did $132 billion last year. CVS did $322 billion. So overall, I would say that CVS is the winner because not only are they doing more than 2.5 times the amount of revenue, but also they're growing revenue faster. Then we get to net income. Walgreens grew net income at an average of 7%, CVS only 1%. And Walgreens is actually doing slightly more net income than CVS, which is kind of surprising. So Walgreens is going to get the W for that one. Then we get to ROI, and the 10-year range for Walgreens is between 2 to 15%, and CVS is 3 to 16%. So very similar, but CVS has a slightly better ROI over the last decade. Then we get to profit margin. 10-year range, once again, for Walgreens, it varies between 0 to 4%, and same thing for CVS. So this one is a tie. However, when you look at the last 5 years or so, I added up all the different profit margins for each year, and Walgreens has been slightly more profitable the last 5 years. So they're a little bit more efficient. They're going to get the win for that one. Shares outstanding, it's pretty much the same thing. It's 0% change in both companies over the last 10 years, but Walgreens is actually buying back shares a little bit more than CVS. So Walgreens will win that one. As for the dividend, Walgreens has a 5.5% dividend, with the 5-year average being a 100% payout ratio, which means 100% of their earnings on average has been going to the dividend. Now, there is some outliers in the last 5 to 10, mainly the last 5 years of data, because, for example, Walgreens reported a huge loss in the trailing 12 months. So that's definitely going to make the numbers look worse. And as for CVS, their yield is a little bit over a 3%. And their 5-year average payout ratio is 45%, which means CVS is much more efficient. And really, CVS could raise that dividend to what Walgreens is doing pretty much, and they'd be at the same thing. So you're getting a higher dividend with Walgreens, but you're also, you're taking away all their earnings. So they're not able to reinvest that money. So that's where CVS is going to win that one. As for the PE valuation, we're looking at 6 times the trailing 12 months for Walgreens and 8 times its forward earnings. And then for CVS, we are looking at 26 times trailing 12 months and 11 times for its forward earnings. So Walgreens will get the win for that one. As for their debt to equity ratio, Walgreens is really bad on this one. CVS is not great either, but Walgreens is definitely a little bit worse. They have more in debt than they do in equity. I believe it's like 30-something billion in debt and then 30 billion in equity or something. And then CVS is pretty similar. It's almost a 1-to-1 comparison of the amount of debt versus the amount of equity. So CVS slightly wins that, but they're definitely not doing a great job with the balance sheet either. If we compare the equity on the balance sheet to the market cap, that's what these ratios stand for. So for Walgreens, we have 0.8, meaning 82% of their market cap is their equity. And for CVS, it's 66% of their market cap is their equity. So Walgreens wins that one. We're paying a little bit less for slightly more equity. So most likely a better deal from that perspective. As for cash versus liabilities, we're looking at $4.2 billion of cash for Walgreens and $68 billion of liabilities. Again, these are horrible numbers to have on your balance sheet. And CVS is slightly better, $15.7 billion of cash with $157 billion of liabilities. So CVS wins that one, but to be honest, they're both doing a pretty horrible job with those numbers. They have more than 10 times liabilities than they do cash. So that's not a good scenario. As for cash versus their average income, I just like to measure this to see if the company is stacking up cash how they should be. And if they have, if we have a pandemic or we have bad years, a bad year here and there for these companies, they need to have cash on hand to take care of some of those expenses. It just kind of shows, are they being responsible with the way they're investing their money and stacking up cash on the balance sheet. So they have, once again, Walgreens is 4.2 billion of cash, average income of 4, which means they have slightly more cash than their average income. CVS, on the other hand, is 15.7 billion of cash with $6 billion on average of net income. So 2.6 times the average income, which means CVS is going to win that one. And then we have number of locations. This doesn't really count as a score. This is just to get an idea of how many locations they have. Walgreens has 8,800 and CVS has 9,600. So CVS is slightly larger. This score is from the score I added here. This is from this website, Qualitrim. So what this does is the website gives you a score, this, however you say that. Walgreens has a 4 and CVS has an 8. And what this measures here is this score is measuring, do they have positive net income, positive return on assets, positive operating cash flow from operations being greater than net income, a lower amount of long-term debt in the current year, and all these different things, right? So that's what that is. That's just another metric. It looks like CVS is doing a better job with all those numbers as well. So all in all, we have CVS has a score of 7, Walgreens has a score of 5. So CVS did do a better job than Walgreens on 2 more of these metrics, which means CVS is our winner here. Now, looking into some more things, here is Google Trends for both companies. As you can see, they're pretty much the same thing. They pretty much have the exact same amount of search volume. There are points when there's several points where Walgreens is higher than CVS. So as you can see with these spikes here, all these spikes has the red going higher, which means Walgreens is getting searched for more. Not that that makes a huge difference, but it is something showing you people's interest in the companies. Then we have this Walgreens stock it just keeps going down further and further. And in the last week, it's because California said they're not going to renew their $54 million contract with Walgreens because of Walgreens' decision over the abortion pill, which means a group of Republican attorney generals warned Walgreens that they would face consequences if they were selling abortion pills. And so Walgreens said, okay, we won't sell abortion pills. Well, California does not like that. And so they said they're not going to do business with them. Now, we'll see what happens with this. We'll see how Walgreens reacts. Maybe something changes and they fix this. I'm sure they will. The other way to look at this is Walgreens and CVS are almost identical companies. So if Republicans are saying that to Walgreens, you would think they'd say the exact same thing to CVS. So we'll see what happens there. Obviously this is bad news in the short term for Walgreens, but either I think something similar is going to play out with CVS, or they're going to come to a mutual agreement and something's going to happen. The state of California cannot just ban all Walgreens and CVSs. I don't think that's realistic. So we'll see what happens there. Now, I have never owned a position of CVS. I've owned Walgreens for a very long time. And from the looks of this, you can see that it looks like I bought too much too early on, because this is one of my larger positions. And I'm down 26% right now. So not the best case scenario. And I mean, I'm kind of torn between buying more shares to lower my cost basis, because I do think Walgreens will get back up above $40 a share, hopefully maybe even $50 a share, but that could take a while. So we'll see what happens. As we just saw, CVS is running their company slightly better. So on some metrics, Walgreens is actually doing better. But all in all, it looks like CVS is the better ran business. So that's what makes me kind of hesitant about Walgreens. I don't think it's realistic for Walgreens to go out of business, but is it possible for them to shut down more stores, or CVS takes more of their market share, or something like that happens and that would cause the stock to go lower, or their profit margins get worse, things like that? This stock could turn into a $25 stock or something. So there is that possibility that kind of, I'm keeping that in mind when I go to buy other shares. But if this keeps falling and it gets down to $30 a share, then yeah, I'll buy more shares. And we're talking it's trading at a P/E ratio of 7, 8, 9 in that area. So there's a very good chance that this stock comes back to $45 a share over the next 12 months, maybe 18 months at the most. So that is the analysis and comparison for Walgreens stock and CVS. Thank you for watching. I will see you in the next video.